If you're sitting there thinking the stock market is some magic vending machine that spits out money whenever you put in a coin, or that a flashy tip from a friend, a TikTok video, or some hot app will make you wealthy overnight, let me stop you right now. That's not how wealth works. I've watched hundreds, maybe thousands, of people think that way and fail spectacularly. And I'm not talking about losing a little here or there. I'm talking about losing decades of potential wealth, literally throwing away years of work because they didn't understand the rules. Most beginners I see, or even seasoned folks, for that matter, make the same mistakes over and over. They panic when markets drop. They chase trends like kids chasing fireflies. They confuse activity for actual progress. And make no mistake, those mistakes aren't small. They can cost you a fortune or worse, your entire financial future. I remember early in my career seeing someone I respected jump on every market tip like it was gospel. One month they were raving about a tech startup. The next, they were complaining about how unfair the market is. It wasn't unfair. They just didn't understand what they were doing. They were gambling, plain and simple, and that gamble cost them tens of thousands of dollars, maybe even a lifetime of compounding. So if you're ready to stop making the same mistakes as everyone else and actually take control of your financial future, you're in the right place. Today, I'll show you exactly what not to do and why, so you don't waste years learning the hard way. Here's the hard truth: most beginners treat investing like a game of roulette. They buy what everyone else is buying. They follow hot tips from friends or random influencers. They are glued to financial news, watching every dip and spike like it's life or death. I see it all the time. Young investors think they need to make big moves to get big results. They hear a rumor about the next big stock, throw in their money, and then wonder why they lose it all. Middle-aged folks hoard cash under the mattress, terrified that one wrong move will ruin them. And older folks, they sit paralyzed, watching opportunities slip away decade after decade because they let fear, or worse, overthinking, stop them from acting at all. Ignoring the problem won't make it go away. If you're nodding your head thinking, "Yeah, that's me," good. You need to feel that discomfort. Financial anxiety isn't fun, but it's a wake-up call. It's the first step toward actually fixing the mistakes that can destroy your financial future. I've seen otherwise intelligent people sabotage themselves in ways you wouldn't believe. People with great jobs and high incomes lose it all because they think they need to time the market, or they over-leverage themselves. Others miss out on compounding because they start too late or not at all. Now, let me make this crystal clear. You can't control everything in the market. Crashes happen, recessions happen, companies fail, but you can control your approach, your mindset, and your discipline. That's what separates the wealthy from everyone else. The same rules work whether the market is booming or tanking. You just have to follow them consistently. Here's what I've learned over more than 70 years of investing. Wealth is simple. I didn't say easy simple. There's a huge difference. You don't need insider tips, complicated strategies, or luck. You need patience, discipline, and the courage to do what most people won't. Most people overcomplicate everything. They're chasing spreadsheets, algorithms, apps, and newsletters, thinking complexity equals intelligence. It doesn't. Complexity is just a distraction. I've watched brilliant people destroy their wealth because they overthought or overreacted. The reality is this: a few simple, consistent principles will outperform any hot tip or short-term scheme every single time. By the time you finish watching this video, you'll understand the biggest mistakes that crush beginners, why they happen, and how to avoid them. You'll learn practical lessons you can implement immediately. You'll leave with a blueprint for intelligent wealth building, one that doesn't rely on luck, hype, or constant market watching. Let me give you a preview. We're going to cover 5 of the most costly mistakes beginners make, plus a few myths that keep people poor, and finally, a simple framework to follow that can protect you from 90% of the errors most investors make. And if you pay attention and follow it, you'll be far ahead of 90% of the people who think they're investing wisely right now. Before we get into the lessons, I want you to remember one thing. Your future wealth depends more on what you don't do than what you do. Avoiding mistakes is far more important than chasing gains. Most people learn that too late. Don't be one of them. Lesson 1 seen. Stop chasing trends. I stopped chasing trends the day I realized one fundamental truth. Most people are always wrong at the same time. That's not cynical, it's just history repeating itself. Early in my career, I heard about some hot new stock everyone was buying. It was all the rage. I thought, this is it. This is how you get rich fast. So I bought in, along with dozens of my peers. For a brief moment, I felt smart, but a few weeks later, the stock tanked. And why? Because I followed the herd instead of understanding the business. That was an expensive lesson, but a valuable one. I realized that trends don't make money. Understanding businesses does. And trends, they often lead you over a cliff. Take technology booms, for instance. In the late 1990s, everyone was buying .coms. No profits? No problem. The stock kept going up until it didn't. Then millions of investors were left holding nothing but worthless paper. I watch friends panic sell and swear off investing entirely. Here's the principle: invest only in businesses you understand. Not because it's sexy, not because your friends are doing it, but because you can confidently evaluate its long-term potential. When you ignore the noise and stick to fundamentals, your wealth grows quietly over decades. Not in bursts of hype, but steadily and predictably. Make a rule: no investment until you fully understand the business model, the management, the market, and the risks. If it feels like you're gambling, don't do it. Trend followers often confuse luck with skill, and that's a dangerous trap. Lesson 20. Don't confuse activity with progress. I used to watch brokers jumping around, making dozens of trades a day. They thought activity was intelligence. It wasn't. Most of them were losing money, sometimes spectacularly. Here's a simple truth: frequent activity rarely equals better results. Investing isn't about doing more, it's about doing right. Doing nothing with the right investment will almost always beat frantic action with the wrong one. I learned this early when I invested in a simple, boring insurance company. Everyone laughed. It's not exciting, they said. But over decades, it quietly grew my wealth far more than any trendy stock I could have bought. Compounding doesn't care about excitement. It cares about consistency. Set a clear strategy and then stick with it. Review your investments occasionally, but don't let every headline or market dip dictate your next move. Remember, the market is a device for transferring money from the impatient to the patient. A young investor once asked me why I hadn't sold a certain stock despite it underperforming temporarily. I told him, if you invest in good businesses, their value doesn't disappear overnight. Your impatience is not a strategy. Lesson 3. Fear and greed are your worst enemies. Fear and greed are like invisible hands controlling most investors' decisions. And not in a good way. I've lived through recessions, crashes, and panics. Every time I see the same mistakes: people sell when they should buy and buy when they should be cautious. Take the market crash in the 1970s. Everyone was screaming, selling, and running for the exits. I, on the other hand, saw opportunity. I bought stocks at half their previous value. Fear made others poor. Discipline made me wealthy. Greed is equally destructive. People chase the next hot stock or leverage themselves to the hilt, thinking they can outsmart the market. They often lose everything. Treat fear and greed as signals, not commands. If everyone is panicking, ask yourself why. Maybe that's where opportunity lies. If everyone is euphoric, slow down and scrutinize carefully. Rational, calculated decisions always outperform impulsive ones. Keep a journal. Every time fear or greed makes you want to act, write down the reasoning behind it. Then review after a month. You'll start seeing patterns, and eventually those emotional impulses weaken. Lesson 4. Avoid debt like the plague. Debt is the silent killer of wealth. I've seen brilliant, disciplined people wreck their financial lives because they treated debt like a toy. Credit cards, margin loans, exotic products, they can all crush your future if misused. One friend of mine borrowed heavily to invest in what he thought was a sure thing. The investment failed, and suddenly he owed far more than he realized. That was a harsh, unforgettable lesson for both of us. Leverage magnifies gains, yes, but it also magnifies losses, and often losses are permanent. Even moderate debt can drain your flexibility. Imagine a stock market crash. If you're leveraged, you're forced to sell at the worst possible time. If you're debt-free, you can hold, buy more, and let the market recover. Avoid debt whenever possible. Never invest money you can't afford to lose. Wealth isn't built on borrowed money. It's built on patience, discipline, and reinvested returns. Live below your means. Pay off high-interest debt immediately. Keep some cash reserve. Treat leverage like a tool for seasoned pros, not a shortcut for beginners. Lesson 50. Compounding is king. Compounding is the quiet engine of wealth, and almost everyone ignores it because it's boring. It doesn't make headlines, but over decades, it turns pennies into fortunes. I started investing when I was 11 with only a few dollars from a paper route. By reinvesting dividends and letting time work its magic, that small start grew into millions. And the beauty, I didn't have to chase every trend or gamble on luck. Here's a simple illustration. Imagine you invest $1,000 at a modest 10% annual return. In 10 years, it becomes about $12,600. Not exciting, right? But over 40 years, it grows to over $45,000, and that's just $1,000. Now imagine starting early, adding small amounts regularly, and reinvesting everything. That's the power of compounding. Start early, even if it's a small amount. Reinvest dividends. Don't touch the money. Let it grow while others chase fads and panic at every dip. Time beats luck every single time. There are countless myths that keep beginners from building real wealth. Let's tackle the most dangerous ones so you don't fall for them. I started with almost nothing. Literally, my first investment was just a few dollars from a paper route. The key wasn't starting with a fortune. It was starting consistently, intelligently, and early. I've seen people inherit millions and blow it all because they treated money like a game. Conversely, I've seen modest income families grow a small nest egg into a fortune simply by being disciplined. Wealth doesn't require luck. It requires time, consistency, and smart choices. Start today, no matter how small. The earlier you start, the more time compounding has to work for you. Don't let excuses like, "I don't make enough," stop you. It's not how much you start with, it's what you do with it over time. Wrong again. Most people lose money chasing hot stocks because by the time you hear about them, the market has already priced in the hype. I've watched tech booms, oil booms, housing booms. The same pattern repeats. Everyone piles in at the top, and the sure thing becomes a sure disaster for the impatient. Example, during the dot-com bubble, people were buying companies with zero earnings, zero profits, and sometimes zero products, and yet there were stories of friends cashing out at the last minute, but the majority, they lost everything. Stick to what you understand. Invest in businesses with lasting value, strong fundamentals, and trustworthy management. That's how wealth is built, quietly, over decades, not by chasing the next fad. No, it isn't. Complexity is a distraction. People get caught up in formulas, algorithms, insider tips, and financial models, and some of them might even make money, but more often, complexity is an excuse for impatience and overconfidence. Wealth favors the patient, not the clever. Simple, proven rules consistently applied beat brilliance with chaos every single time. Keep it simple. Know the business, understand the numbers, and invest for the long term. Complexity doesn't create wealth, discipline does. I call this framework SIPPL, simple, intelligent, patient, protect, learn. Follow it, and you'll avoid 90% of the mistakes beginners make. Simple, only invest in what you understand. If you can't explain it in simple terms, don't invest. A business is either understandable or it's not. If you can't grasp the fundamentals, revenue, profits, management, risks, walk away. Example, I avoided investing in early tech startups I didn't understand. Others chased trends blindly and lost fortune. Simple understanding separates winners from losers. Intelligent, make decisions based on facts, not emotion. Investing is not a popularity contest. Facts matter. Numbers matter. Discipline matters. Practical tip. Before investing, write down the reasons you believe in the business along with the potential risks. This investment thesis keeps emotions out of the picture during panics or euphoric highs. Patient, let compounding work over years, not days. Patience is the unsung hero of wealth. Compounding doesn't care about your excitement, it rewards those who wait. Example, I've held companies for decades, reinvesting dividends and letting growth accumulate quietly. By the time the market notices, patience has already done the heavy lifting. Protect, avoid debt and unnecessary risks. Leverage is tempting. Credit cards are convenient. Margin accounts seem clever, but these are traps for the unwary. Protect your capital, avoid debt whenever possible. Your ability to withstand market swings is the ultimate advantage. A friend borrowed heavily on margin, thinking a sure thing would triple his money. When the market turned, he lost everything and more. Protection matters more than speed. Learn, keep observing, reading, improving. Even the best investors never stop learning. Markets evolve, businesses change, and human behavior repeats in predictable ways. Stay informed, but don't obsess over daily news. Study history, read annual reports, and observe patterns. Knowledge compounds like money. Dedicate 30 minutes a day to reading about business, markets, or finance. Over a year, that's 182 hours of compounding knowledge, enough to put you decades ahead of the average investor. Let me be blunt. Most beginners fail not because they don't know something. They fail because they refuse to follow basic rules consistently. They chase hype. They panic. They invest based on emotion. They ignore compounding, and they don't protect their capital. If you do the opposite, if you invest only in what you understand, ignore fear and greed, start early, stay disciplined, and let time do the heavy lifting, you'll look back 20 years from now and be grateful you started. You won't wish you had done more. You'll be glad you did the right things consistently. Here's the reality: most people never grasp. Wealth isn't flashy. It's quiet. It's boring. It's not about the next hot stock, the latest newsletter, or the social media hype. It's about patience, discipline, and compounding over decades. So, if you want to change your financial future, start today. Apply these lessons, avoid the common traps, stick to the SIPPL framework, and remember, time is your ally, not your enemy. If you want more of my hard lessons without sugar coating, subscribe and don't miss the next video. I'll keep showing you what most people never learn until it's too late. Because the truth is simple: wealth doesn't require genius. It requires patience, discipline, and the courage to do what most won't.